everyone, thank you so much for joining. In this video I would like to give you an idea what fair value hierarchy is, because when we talk about impairment, valuation, we talk about fair value quite a lot. So I wanted to give you additional information to better understand, okay, what is fair value. In general, fair value hierarchy is a framework that is established by IFRS and US GAAP. So there are different principles that classify how the fair value of an asset or liability is measured based on the level of data and assumptions available. There are 3 levels of the fair value hierarchy, and this really depends on what information is available. So ideally, you would use level 1, observable inputs, quoted prices in active markets. This would mean you would value an asset or liability by using directly observable inputs. Very important, determined by directly observable inputs, such as market prices for identical assets or liabilities in active markets. An example could be publicly traded stocks, bonds, or mutual funds with prices available on exchange. So you exactly know what the price is because the price is observable, is quoted, and you have an active market. Yeah. Also, when you look at commodities, gold, oil, they are actively traded on exchanges. Yeah. So this is level 1. This is considered the most reliable and objective level of fair value measurement because you have an active market and you basically know the price. If for certain reasons there is no active market and the good is not actively traded, then we go to level 2, which is called observable inputs, indirect or similar markets, which means the fair value is based on inputs other than quoted prices in active markets, but are still observable, such as market prices for similar assets or liabilities. For example, bonds or loans that are not traded on active exchanges, but priced using interest rate, credit spreads, or other observable inputs, so it's an indirect valuation, or derivatives. For example, interest rate swaps, forward contracts, they are also valued using observable inputs like yield curve. That's level 2, observable inputs, but indirect or a similar market where there's no active price available like level 1. If this is also not available, then we go to level 3. Level 3 is even less reliable than level 1 and level 2. Level 3 is basically unobservable inputs, internal estimates. The fair value is based on unobservable inputs such as management's own assumptions or models because market data is unavailable. Could be valuation of private equity investments or illiquid securities, real estate or business valuations relying on projected cash flow and discount rate. There's no price available. If you want to value real estate or a business, you need to come up with external or internal estimates. That's why we do DCF analysis and so on, because there's no price tag directly observable and available. Reliability, it's the least reliable and most subjective as it depends heavily on estimates, internal models, and management's judgment. Yeah, hope that's clear. Thank you so much for listening. See you in another video. Bye bye.